Hey everybody, Joel Pal Brian Hunt. Welcome to another episode of 60 Seconds of Risk. Today we're going to talk about a concept we've explored in the past. Specifically in episode number 88, we talked about surety bonds and how it works. And a surety bond is kind of like insurance, but insurance is a two-party transaction between you, the insured, and the insurance carrier. But in bonding, it's actually a three-part transaction between you, the principal that you're dealing with, and the surety company who's sort of backing that things up. And we're going to talk about that again. But we're going to talk about an aspect of bonding that's been sort of, a lot of people don't know about, but it's been sort of brought to the forefront these days based upon what's going on in the world with tariffs and trade wars. And that is actually talking about a surety bond. And that may sound kind of strange, but we're going to walk you through the example, and we're going to use a specific example you might be very familiar with. So we in this country import coffee. We do not grow coffee here in the United States, and as a result, we have to import it. And the biggest market we do that for is in Brazil. But as a result of the current administration's desire to somehow bring back more manufacturing to the United States, even though you don't make coffee in the United States, this actually is more of a political issue where he's trying to change policies inside Brazil because we don't import coffee. But let's walk through this. So, like a lot of you probably go down and buy coffee from your local coffee shop. I actually bought this from White Rock Coffee. This particular coffee is not coming from Brazil, but let's assume it is from Brazil. And being like whether you're White Rock Coffee or Starbucks or whatever the case may be, you're going to need to bring in coffee to the United States to support the demand of your clients. In this situation, like I said, Brazil is one of the top markets. And let's say you, on an average, maybe on an annualized basis, you buy $1 million USD of coffee from Brazil. And on a regular basis, you bring it up and you get it to the Port of Houston. And let's just say in this situation, there was no tariffs before. It was strictly you buy $1 million worth of coffee from Brazil, it comes to the Port of Houston, and you, the importer, will collect delivery, and you'll pay that $1 million from the original provider, grower in Brazil, and that's the deal. However, when you slap a tariff on it, and in this situation, due to the current trade wars, take your coffee, slap a 50% tariff rate. Again, 50% is the current tariff rate for importing coffee from Brazil. This is now going to be an additional cost to the importer. And as a result, you now got to pay, in this situation, $500K to U.S. Customs. And don't be confused, people. A tariff is a tax. You are paying additional tax to bring in this material from Brazil. Customs is now going to slap $500K. So which now actually means, you think about this transaction now is going to cost you 1.5 million USD. So, and again, the importer's costs have gone up, and we'll talk about that. But here's the deal. Customs wants their money immediately. They don't take sort of payment installment plans. So what has to happen, and this could be a cash flow problem that a lot of people don't understand. You're the importer, you're sending out $1 million, now $1.5 million, and the intent is you're going to go out and sell this to someone else at a markup, but that cash may not be coming in until later. So this right now is a big hit to someone's cash flow. How do you get over that? Well, either the importer's got to pay the $500,000 right here, right now, or they can delay it in order to hopefully make the sales and get their money in, therefore pay the tariff. But how do you get delay? Well, that's where a surety bond comes into play. Remember, if we go back to episode 88, surety bond is three components. You have the principal, in this situation, is going to be the importer. You have the obligé, who is you are basically obligated to. But what happens here, the surety company is going to issue a bond to Customs saying that we, the surety company, have done our due diligence. We can stand behind the importer and guarantee that this money will get to you eventually, and typically within 10 days. But this is going to be additional cost based upon the contract. And so this could be, in this situation, let's, for the purpose of this conversation, call it about $10,000 is going to be the cost of this bond. An additional cost that the importer has to eat. Remember, more costs on the importer. But this situation is no different than we talked about when if you're trying to get bonding as a subcontractor to do a job. The surety guys are going to dig through your financials. They're going to understand your capacity, and they want to understand your character, because they are basically putting their financial assets on a hook to back up paying of this tariff. And here's the thing. In this market, there are probably a lot of importers finding all of a sudden they've got to get tariff on, but they may not have this program in place. We've talked about in the past, episode 88, getting a bonding program requires a lot of due diligence, financial information, providing good financials to make the surety company feel comfortable taking on that risk and backing you up to the U.S. Customs. It takes time. And so there's probably a lot of importers now finding out that this is a big hit to them. So they're going to have to try to scramble to get a surety program. And that's unfortunate, this current environment we're on, that we as a country have decided to increase the costs to the importer. And what is the importer going to do? He's here to make profits. So when he passes on to final sales, he's not going to, unless he raises his costs, unless he raises his sales price, it's diminishing his margin. Hence, as we're seeing, and as I actually bought my coffee today, coffee has gone up directly as a result of these tariffs. So when you go to your store and you're finding the coffee is going through the roof, why is that? Because we as a country are slapping tariffs on the import of, especially like for Brazil, which is the largest importer of coffee, at a 50% rate. But in order for the importers to do this, either they got to pay this up front immediately when it comes to the port, to the U.S. Customs, or you got to get a surety bond. And the surety bond can be a great way to sort of bridge this gap from the cash flow perspective, because again, importer's got to pay it immediately, and this might be a delay in time he gets his money on the final sales. So this can be a way to bridge the gap to get cash flow evened out. But this process does not happen overnight. As we talked about in episode 88, the surety company wants to have good faith and understand that you're going to be good to make this payment, because if not, they're on the hook. So like all things, guys, things change in this economy, things change in this industry, and as a result, the risk can change from left to right. That's why hopefully, people understand that now surety bonds are a function out there that you can look into if you're in this situation where you're having to import material and you got a cash flow situation. So hopefully you found, like all things, guys, hope you found this information informative and beneficial. If there's a certain topic or individual you'd like to see on this, please post a note on LinkedIn. You can also subscribe to this video, all my other videos on my YouTube channel on YouTube. You can find the links to these videos on the website formerly known as Twitter, Blue Sky, Facebook, and Substack. Until next time, guys. Bye.